Welcome to Investment Portfolios, and this is your online instructor, Diana Block. And this week we're going into a discussion of some fixed income investments for our portfolio. So when we talk about fixed income, primarily we're discussing bonds. And once we've determined that we do want to allocate part of our portfolio to bonds, the decision to make is exactly how do we want to own these bonds. So of course we have the option of buying individual bonds or a mutual fund that invests in bonds. And which is the right answer is going to depend on the individual and their investment goals, of course. But there are some what could be considered pros and cons of each type of approach. And in some cases, you may combine individual bonds with some ownership in bond funds as well. So let's just look at the basics. Of course, individual bonds are going to pay out that defined amount of income at regular intervals. Usually we're talking about twice a year. This is your coupon payment, and it's going to be a fixed amount. And then, of course, the fixed amount of the bond principal is going to be returned to you when the bonds mature. That's how the individual bond works. Now, with a bond fund, this is just like a stock mutual fund. You're going to put your money into a pool of investors with other investors, and then you'll have a professional manager that's going to invest that pool of money into their best bond opportunities. And some of the bonds are probably going to look to copy the market or follow the market indexes for bond performance. And you're going to have a mixture, most likely, of short and long-term bonds. You're going to have a variety of issuers. You may have some government bonds as well as other U.S. government and other local government agencies, probably some corporations, and even some more specialized things. You may be a part of a bond fund that focuses on a narrow mix, such as just short-term treasury bonds or some kind of corporate junk bonds or high-yield funds. So there are options even within the bond funds, but in general, they're just like a mutual fund. And so that being said, there's going to be some comparisons that we can make from individual bonds to a bond fund. So most notably, how is it going to be managed? With the individual bond, of course, it's going to be managed by the individual investor. They will buy and sell the bonds of their choice, individual bonds. With a bond fund, you're going to have a professional money manager that's going to determine which bonds best meet the needs or objectives of the fund. Now, one of the major differences you'll see is that in the area of maturity. With the individual bond, of course, there's going to be a set maturity date, as we discussed, when you'll receive your principal back. Although some bonds could be called prior to maturity, that is a possibility that you'll have bonds be called. In general, your expectation is that on a set date, the bonds will mature. With a bond fund, usually there is no maturity date. What happens is bonds are being constantly bought and sold into the fund. And so the fund's perspective is going to outline the weighted average of the maturity of all the bonds that are in the portfolio. But again, that's going to change a lot based on how active that bond manager, that fund manager is. When we look at the income payments, if you purchase individual bonds, are basically going to be fixed. You're going to have, based on your coupon, some bond income, either maybe monthly or quarterly. Usually, though, it's a fixed semi-annual income payment. Now, with a bond fund, again, because bonds are being bought and sold regularly, you're going to have monthly income distributions, but it's going to fluctuate based on what bonds are in the fund at that particular time. And so when we look at the concept of market risk, now with an individual bond, of course, if the bond is sold before maturity, the market price could very well be higher or lower than what you paid for the bond. So we're familiar with that. And so if the bond price is higher or lower than what you paid, that could lead to a capital gain or loss. But if the bonds are bought and held to maturity, you're not going to be affected by market risk. You're going to receive the face value of that bond. You'll be affected by inflation, but not the market risk. However, if you are invested in a bond fund, market conditions are going to constantly affect the value of the fund. Although the diversification that's in a bond fund is going to reduce that market risk, you're not going to have as much risk from any one bond issuer. But when you redeem shares of a fund, the sale could always result in a capital gain or loss. So your bond fund values are always going to be affected by market values. So that's something to consider as well. Let's look at some other differences between individual bonds and bond funds. How is diversification affected? Well, in order to diversify with individual bonds, this is going to usually require a pretty large investment because you're going to have to buy a bunch of negatively correlated bonds individually. And each bond that you invest in is likely going to have a minimum requirement for purchase. With a bond fund, however, just like any mutual fund, the benefit of it is that it's got built-in diversification. The bond fund is going to invest in a lot of different individual securities, which is going to provide you with diversification for the minimum investment of the required amount to buy into the fund. So let's look at or talk about credit risk some. So, of course, with the credit risk, it's going to be based on the bond rating. Higher rated bonds, blue chip bonds, are going to have a lower risk of default. Lower rated bonds, junk bonds, are going to have a high risk of default. Bond funds, though, again, like a mutual fund, the credit risk is going to depend on the actual quality of the bonds that are in the fund. So that's going to vary according to the type of fund and that fund's objectives. Some funds will be seeking high yield, high risk bonds. Others may be focused on blue chip or a combination. But the point being that a bond fund is going to provide you with some diversification. It can. And that in itself will help to mitigate your credit risks that you're exposed to. Another area I considered when I was writing this was the cost of it. The cost of individual bonds is going to be basically your dealer price markup at the time of the purchase. And so the markup is the difference between the dealer's price and their sale price to you, the customer or the investor. With bond funds, you're going to see ongoing annual expenses, just like a mutual fund. This is going to be your management fees and other fees. They may have a sales charge or transaction fee at the time of purchase, but there's also going to be an annual expense ratio to cover those other ongoing professional management fees. So even with this information, what you choose to focus on or include in your portfolio as far as fixed income investments could be individual bonds, bond funds, or a combination of both, depending on your objective goals. You may want to consider discussing this in your paper, how you're deciding between these two options and what significant factors related to this are important in your particular portfolio. So this is the information I wanted to share with you this week. Remember that you have an assignment as well as discussion that should be participated in by Wednesday, and also the lecture review should be done by Wednesday. If you don't get to it, remember you can always still do that late. It's better to go ahead and participate in the discussion and complete the lecture review even if it's past Wednesday, although it's great if you can do it before Wednesday so you have the most benefit of this information as you're going forward. If you have any questions about it, you can always send me an email or give me a call if that's more convenient for you. And we can also talk in the discussion area about these topics as well if you would like. And so that's all I have for you today, and I wish you a great week. Thanks.